And that means there's a major shift in the way you need to think about markets, right? If we are now in an inflationary, a systemic inflationary environment versus a disinflationary one that characterized the past 40 years, that is a paradigm shift. That means you have to change the way you think about everything. Portfolio construction, what assets are desirable versus what are not desirable in that environment. There's going to have to be rapid repricing or significant repricing in a lot of different asset classes. And I think that's something that people just aren't aware for, they're not positioned for, and it's very problematic.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart. It's been a rough year for the markets, with the majority of financial assets still down double digits since the start of the year, but considerable speculative froth still remains. Does that mean prices will eventually have to go even lower from here? Macro researcher Jesse Felder has been tracking this closely of late, and we're fortunate to have him return to the program. Jesse, thanks so much for joining us today.
It's a pleasure, Adam. Thanks for having me.
Oh, Jesse, it's always a good time with you here. All right, well, look, let's got a lot of questions for you, but let's start with the one we always begin with, very high level, answer any way you like. What is your current assessment of today's global economy and financial markets?
Well, I do think we are in the early stages of an economic recession and bear market. I think the rally we've seen over the past month is indeed a bear market rally. It's driven primarily by short covering. But I mean, there's at least two, if not three major indicators I've been paying very close attention to for months now. The thing I follow probably most closely is insider activity, just executive buying and selling in the stock market. And the reason this indicator on a macro level is so important is that the overall sell to buy ratio, when you average it over a 12-month period, leads the stock market and the economy by 12 to 24 months. And so when you see insiders buying heavily, that's really a good sign for the stock market over the next 1 to 2 years. And it's also a really good sign for the economy that the executives are very confident in what the outlook for earnings and things looks like. Insider activity got about as bearish as I have ever seen it late last year. So mid to 2021 to late last year, we saw the sell to buy ratio on a 12-month basis go over 30, which is huge. I mean, normally 20 is pretty high. You get down to 10 is pretty bullish. We were just off the charts bearish last year. And that's a pretty good sign that the stock market and the economy over the next 12 to 24 months are going to be a lot weaker than people anticipate. We've seen that, right, with economic slowdown, and we've seen it with the stock market action so far this year. But there's another, I think, more fundamental macro indicator that validates the view that insiders were telling us, 6 to 9 months ago. And that's when you get a rising dollar, rising interest rates, rising oil prices, that is a very bearish trifecta for the economy and for corporate earnings. That's another one that leads by 12 to 24 months. And we've seen all three of these things for the last 2 years just rip higher. Obviously, interest rates bottomed in early to mid 2020 and have been rapidly rising. Oil prices went negative, right, and then went over $100 a barrel. That's a huge reversal. And the dollar weakened significantly when the Fed started its money printing in 2020 and has been much stronger. So those three headwinds are a pretty good leading indicator of manufacturing activity, all the standard kind of things you see, and were very supportive. When they declined so significantly into the early days of the pandemic, that created a very strong fundamental tailwind for the economy and earnings over the past 2 years since they declined. Now those have all turned very bearish for both the economy and corporate earnings. So I think those are things that are telling me that it's time to be very cautious towards risk assets and the economy in general.
Okay, so great list, and I want to just ask back to your insider activity statistics there. You said it was about the most bearish you'd ever seen at the end of last year, and this year seems to be proving that out. Where is it currently standing right now? Has it improved at all? Is it still bearish?
It's a great question, right? So I follow two metrics, really, the 12-month average and a 12-week average. So the 12-week average has actually, in mid-June to July started getting pretty bullish, where we saw it get down to about 5 times. That's the 5 times the dollar value of sales versus buys. So that was kind of a short-term, very bullish indicator. And pairing that with the amount of extreme positioning on the short side, right? We still see it. And it's one of the concerns, I think, for the bear case right now is you see extreme positioning on the short side, which created the potential for the type of short squeeze we've seen over the past month. But yeah, insiders have gotten pretty bullish over the short run. But at the same time, that long-term measure is still at about 16, 17 times, sales to buys. So that's still not come down to a level that is typically bullish for a 12 to 24-month time frame. So I think the short-term measure is saying, yes, it was pointing to we could have seen a rally here, we did, but the long-term measure is still saying we're not at a good point where it's where it's safe to start buying risk assets on a longer-term time frame.
Okay, so first off, this makes total sense, right? I mean, the captains of industry are the best ones to know what's happening out on the economic ocean, if I can murder that analogy here. But these are the guys that are running the companies. They're the closest to the heartbeat of the global economy. They're likely to know better than anybody else where things are likely heading, right? So they got real pessimistic. You said it's become more bullish in the nearer term here. Has it become more bullish, or has it just become less bearish? Because it sounds like you said it's still, sales are still higher than buys right now, even on that shorter time frame. Did I hear you correctly?
Yeah, and I think it's really important to point out, a lot of people like to look at this from a macro perspective without kind of parsing the data to understand where is the buying happening, where is the selling happening. One of the most bearish things that I've seen this year is even in April, we still saw a significant amount of insider selling in the tech sector. That's very bearish. When you see prices fall 50% and insiders are still selling, that's not a good sign. That's very worrisome. And that was one of the things that kind of marked the insider activity. By the same token, we've still seen significant insider buying. To the extent there has been buying, it's been in the energy sector. We've seen significant buying as oil prices have pulled back, and especially in kind of like the pipeline and infrastructure stocks. I've just seen consistent buying there for 2 years, really since the fall of 2020. Energy insiders have been very, very bullish. And so you can use this stuff from a macro perspective, but it's also, I think, important to kind of dial down to the micro level and see where is the insider buying and selling. And earnings kind of bear this out, right? Energy is really the only bright spot in corporate earnings right now, whereas every other sector looks like we're entering an earnings recession. It's just energy that's kind of holding up the whole put together the earnings picture. So I do think it did in the short run get to a macro bearish or macro bullish picture, but that's really just kind of more of a short-term trading perspective, doesn't speak to the longer term process. And that's really what I think most investors are most interested in, is when do we get to that point where it looks like the bear market's over, it's safe to get back into the pool again for a long-term buying opportunity.
Yeah, well, so 2 things. One, let's earmark that energy discussion for later on in this conversation when we get to areas of opportunity, because you've written some really interesting recent data on that. Secondly, what I think I hear you saying is even though insiders have become less bearish in the near term here, and of course you got to be careful to see where they're buying and where they're selling, as you said, I don't hear you saying this is the bell that marks the bottom, right? That this is probably more short-term, maybe even more tactical to a certain extent. And you mentioned earlier at your intro that you felt like this bear market, we're in the early stages of it, which implies you think things are going to head down further from here. Am I just capturing your general outlook here?
Absolutely, yeah. Yeah, and I think the reason for this is I think and there's a reason why you have, classic bear market rallies, or, these rip your face off type rallies, because sentiment changes much more rapidly than the fundamental picture, right? I think it's very clear that we're entering an earnings recession, but people came around to that idea and expected second quarter earnings to be terrible. When they weren't terrible, right? All those people that were buying, I mean, the activity in SQQ or SQQQ, the leveraged short NASDAQ 100 ETF was just massive. It was basically the mirror image of what we saw in TQQQ last year. I mean, the interest in these leveraged ETFs is just astounding. We saw retail investors get massively bullish last year, buying tons of call options and all these things. And in June, we saw them switch to buying put options and buying leveraged short ETFs. And then in the futures market, you saw a massive short position. So I think sentiment just got too bearish, and fundamentals, haven't really declined to the point to validate that bearishness. And so you see the short covering rally that we've had over the past month or so.
All right, great. I want to tug on that a little bit because you have been writing recently about the topic of excessive retail speculation, right? And you just mentioned that, kind of coming into this year, you mentioned a couple of ETFs there, and we'll sort of explain what those are for folks, because those are ETFs that let people go short or long the markets on a leveraged basis. And levered long ETFs, and we get a chart here that you put in one of your recent writings, you show that they increased 4 times. From about 10 billion to 40 billion. It's come off a little bit now this year, obviously, because we've had this market drawdown this year, but it's still historically very elevated. And as you just mentioned earlier, in just June alone, we had a 2x increase in the leveraged short ETF volume. So my question is just sort of, I'll let you opine any way you want, but there sort of seems to be this swing for the fences mentality that the retail investor is pursuing here. What does that mean for market stability to you? I mean, is this a very dangerous thing?
I think it's absolutely dangerous. I think, there's been some interesting work done demonstrating the magnification that retail investors have had on stock prices by way of leverage. And we've never seen a bear market driven, by the amount of options activity, leveraged ETFs. All these things are new, right? The last time we had a major bear market, 2008, there wasn't this retail activity on the options market. We didn't have leveraged ETFs to magnify these things. And so I think this is a concern, and it's something that I paid close attention to, because I think we saw in early 2018, the Volmageddon episode, where the short volatility trade imploded. And that was something guys like Chris Cole, were kind of writing about in a couple of years leading up to that, and saying the popularity of these short vol ETFs is going to be problematic at some point. It happened, it blew up in 2018, essentially overnight. And I think that this options trade has the potential to be something similar. When you have billions of dollars of call options purchased on a Wednesday that expire Friday, right? You have market makers end up being short call options. They have to hedge that position by buying the underlying equity. So what happens is you have retail investors can put just a little bit of money to work, and that forces a lot of money to be put to work in the equity markets, which can magnify the upside. I think there's potential to see this if we see the next leg down in a bear market and retail investors really get into put options. You can see this work in the other direction, right? Where retail investors buy tons of put options that are deeply out of the money and expire, weekly options expiration. So they expire on a Friday, they're buying them Wednesday, and they're spending a tiny little bit of money, makes market makers short a put option against a stock. They have to go sell stock to hedge that position. And that's a potential dynamic that's out there that could make for, it could exacerbate an underlying decline in equity prices. And that's something I don't think regulators are paying enough attention to right now. All
right. So it sounds like you think it increases the drawdown risk. obviously playing with leverage and certainly playing with options and whatnot, it's hard not to see that as increasing the probability for bigger losses on the consumer side, right? Because these products they're risky. They're a lot riskier than just buying a straight stock and holding it long. And so as we go into a recessionary environment, inflation, whatever, I mean, all these things are already placing headwinds against the regular consumer. To be sort of playing with these more speculative instruments really seems dangerous given the elevated general level of risk here. I also wonder too if you think that, let's assume that the bear market continues the way that you think it will, which means that investors are going to take more losses and that retail investors are going to take maybe more losses than otherwise because they're playing with risk here. Do we, are we in danger of just that saying of a cat that jumps on a hot stove and gets burned isn't going to jump on a hot stove again? He's not going to jump on a cold stove either. He's just not going to jump on stoves anymore. Could we be creating the potential for sort of a long-term market distrust, if we do have a deep bear market here and retail investors who are stretched like this get excessively burned?
I think it's a really great point. And it's something I worry about. I think it's also one of the things that's driven cryptocurrency. When you talk to, millennial investors, I think that's a big reason why they're looking at things like why they've dived headfirst into real estate over the past couple of years and into cryptocurrencies. Is I think there is a natural distrust of the stock market, and especially I think people understand that markets have been manipulated for a period and whether they actually understand the dynamics of Fed policy and all these things, I think people do understand that the markets haven't been able to operate in a free manner for a period of time, and that makes everybody I think a little bit more cautious, or at least should make people more cautious. So yeah, I do think if we do have another major bear market, and I think that's exactly what we're headed for over the next year to 18 months, then I think it's going to create a rethink. It's going to make people think twice about is the stock market something that you can't, they're going to certainly rethink this idea of passive investing, which, if you didn't have one of the most powerful 10-year bear markets behind you, in the rear view mirror, driving recency bias, the idea of passive investing would sound, almost ridiculous. It's
Sorry, you said bear market, but you meant bull market, right?
I meant bull market. Yeah, exactly. Thank you. If you didn't have that, driving people's recency bias, the idea of passive investing would be almost laughable. And I think it's only the fact that stock prices have been supported by Fed policy for so long, creating such a powerful bull market, that people have become comfortable with this idea. But yes, if we do have another major bear market, like I said, I think we're headed for that. It's going to make people, I think twice about passive investing, think twice about just stock market investing in general, and really, hopefully start to question whether having such an active central bank is in the country's best interest.
All right. Well, we'll get to the Fed in just a second. That's my next, or one of my next questions here. But I do want to keep talking about this just for a second because it raises an interesting question, which is one of the things that I and a lot of the experts on this channel have railed about is that largely because of the Fed, we've punished savers. We've created a massive disincentive to save. So we don't really have a nation of savers anymore. Certainly anyone Gen X or below, but certainly below Gen X, they don't save at all because one, it's getting harder to with affordability issues, but also they just get no return on their savings, right? And millennials, Gen Zs have in many ways turned to cryptos and meme stocks and whatnot, almost out of, yes, distrust, but also out of sort of desperation. Like the only way I'm going to afford a middle-class lifestyle at this point in time is if I get a winning lottery ticket, right? If I get one of these cryptos that goes up 3,000% or whatever, right? So we've not even engendered investing necessarily. What we've done is created a generation or several generations of speculators, right? Basically all everybody is doing is either just trying to figure out what these very few people in the Eccles building are going to decide to do, because that's really what has the most impact on market prices, or they're going out in these highly speculative assets and hoping to hit catch a winning lottery ticket, like I mentioned. So we've really kind of, we've removed the saving and the investing muscles from these past couple generations. If they invested, as you said, it was in passive instruments that basically they didn't have to do any real work. I just bought the sector ETF or whatever. I set it and forget it. I bought the dip. I just held through everything and I was fine, right? So I feel like we've really sort of malnourished several generations of Americans in terms of true wealth building. And I don't want to put words in your mouth, but it sounds like you're saying, the pendulum maybe is finally switching back here, and we're going to go back to the days where old school investing, active management is the way to go, where you've got to do your homework, you've got to understand not just the industry, but the individual companies in the industry, and you got to get into the financial statements and really try to find the diamonds in the rough or separate the wheat from the chaff and build a superior portfolio that way. And I got to say, I got to think most people just do not have the experience or skill set at this point to do it because they haven't had to build it yet. What do you think?
No, I think that's absolutely right. I think the one-way market for, financial assets, generally stocks and bonds, just, stocks only go up type of mentality is only made possible by extreme experimental monetary policy that has targeted asset prices in trying to support the economy. In the rise of inflation over the past year or so basically makes that monetary policy unsupported, right? The Fed can no longer say we're going to target asset prices in trying to support the economy because inflation is essentially, as my friend Bill Fleckenstein has said, is in the process of taking the printing press away, right? So, this is a huge paradigm shift for markets, right? I think, and this is what people don't appreciate I talked about recency bias. People look back at the last 10 years and assume that the next 10 are going to look the same. That yes, okay, when the Fed has to start tightening monetary policy, okay, maybe we have to be cautious for a time, but when they flip-flop back to dovish policy, it's time to buy the dip again. And that is only true if the Fed can actually come to the market's rescue, can start QE up again, can print money, can directly support asset prices. Inflation means they can't do that anymore, right? With CPI running 9%, Fed funds at 2.5%, they just literally cannot change tack right now without opening the door to hyperinflation, right? And that's something that the Fed just can't do. They literally just can't do that. Politicians won't allow them to do that. And they understand how these things work, that is too big of a risk to accept. And so I think the shift in inflation is a systemic shift. It's not a cyclical, it's much bigger than that. It's related to demographics and a variety of other things that are now shifting from a disinflationary environment, deglobalization is another one, to an inflationary environment generally. That puts an end to the type of monetary policy that we've seen for 20 plus years. And that means there's a major shift in the way you need to think about markets, right? If we are now in an inflationary, a systemic inflationary environment versus a disinflationary one that characterized the past 40 years, that is a paradigm shift. That means you have to change the way you think about everything. Portfolio construction, what assets are desirable versus what are not desirable in that environment, et cetera, et cetera. And so I think that is a shift that most investors just still don't see. They still believe inflation is transitory. You see it priced in the markets right now. The markets are still pricing inflation is going to come back down rapidly over the next 12 months and stay there. Look at 5-year break evens, 10-year break evens. They're still pricing in essentially inflation that's going to come back to 2.5 or something, or close to the Fed's target. If that doesn't play out that way, there's going to have to be rapid repricing or significant repricing in a lot of different asset classes. And I think that's something that people just aren't aware for, they're not positioned for, and it's very problematic.
All right, significant repricing in a whole lot of different asset classes. I want to get to that soon. That kind of gets to the like how big do we think this bear market correction could be? But real quick, so I think you just did a really eloquent job explaining why you think a paradigm shift has just happened, both in inflation, globalization, et cetera. Do you think when the historians look back in 10, 20 years, 2022 is going to be the year that marks that shift?
Absolutely. I think what we've seen is a generational bottom in the commodities to stocks ratio. I think it's a generational bottom in interest rates that we saw in 2020. And these are things that play out over a very long time frame. They're not things that, are 6 to 18-month trade. They're multi-years, 5 to 10 year, trends, and if not longer. And we can talk a little bit more about the inflation dynamics, but I think what people are missing when it comes to inflation is, yes, there are cyclical forces. Yes, the money printing exacerbated the underlying problem, but and the pandemic did as well. But there was already a trend towards deglobalization. Globalization is probably one of the most disinflationary forces of
our lifetimes,
many years, at least our lifetimes, if not bigger. Pair that with demographics, right, where you had the baby boomers coming into the workforce right at the right time. Labor supply expanded dramatically, which put a lid on labor costs for a long period of time. And now the baby boomer generation is leaving the workforce, and so we're seeing this is something the BIS published a piece on demographics and inflation 4 or 5 years ago, and it was a very important piece to pay attention to, because it showed when you have a rising dependency ratio, it's essentially the workforce is shrinking relative to the overall size of the population. It's almost always inflationary, and in a very big way. And this is something, that demographic trend that has been growing for a number of years. And so we're seeing rising dependency ratio in most countries around the world now, but especially in the United States, where, and if you read, Goodhart and Pradhan's recent book, The Great Demographic Reversal, they do a great job of taking this information the BIS put out 3 or 4 years ago and really doing a deep dive in it and showing how when you have the productive members of society shrinking versus non-productive members who are still consumers, right? Retirees, they're not producing anything, they're just consuming. That's very inflationary. And so demographics, we have this demographic inflationary shift, and pair that with deglobalization, which is going to raise the cost of production significantly. Those two trends probably just by themselves represent a very important inflationary dynamic on a long-term time frame, which means this disinflationary trend that we've seen since the early 80s is now over. It's really, and we're now in a systemic inflationary environment that will last a long period of time.
All right, well, you heard it here, folks. 2022, the year it all changed. Jesse, I'm just going to reiterate a point I've made in this program in the past, which is related to the earlier one I made, which is everybody running our system right now, pretty much, for their lifetimes, has lived in a disinflationary environment, right? So that's all they know, pretty much, right? So again, I'm going to use the musculature analogy, but the muscles they've developed is, okay, how to deal with disinflation. To your point, we're now moving into a inflationary regime, needs a totally different set of rules. And so, you can make a good argument that the people we have running the system right now are uniquely the wrong people to be running it, right? Because it's like a wide receiver versus a defensive lineman, right? They just have different musculatures. And it's like we're all of a sudden asking the defensive lineman to, be the wide receiver and be the guy who wins the sprint. It's just not going to happen, right?
Well, and if you think about, what do you really need
Our
to?
interview with Jesse will continue over in part 2, which will be released on this channel tomorrow as soon as we're finished editing it. To be notified when it comes out, subscribe to this channel if you haven't already by clicking on the subscribe button below, as well as the little bell icon right next to it. And be sure to hit the like button too while you're down there. And remember, we're continuing our new practice of publishing my top takeaways from these weekly interviews. To get mine from this interview with Jesse for free, just go to wealthion.com/adamsnotes. Finally, if the challenging macro outlook Jesse's detailed in this interview has you feeling a little nervous about the prospects for your wealth, then consider scheduling a free, no-strings-attached portfolio review by a financial advisor who can help manage your wealth, keeping in mind the trends and risks that Jesse's mentioned here. Just go to wealthion.com and we'll help set one up for you. Okay, I'll see you next in part 2 of our interview with Jesse Felder.